I'm Kyle with PCE Investment Bankers, and in this video we'll explain the internal loan in a leveraged ESOP, what it is, how it works, and why it matters. Leveraged ESOPs are the most common way for an ESOP to purchase meaningful amounts of company stock. While leveraged ESOPs are common, the structure can be complex. An ESOP can be set up in one of two ways. It can either be leveraged or non-leveraged. In a leveraged ESOP, the ESOP trust borrows money to purchase company shares. In a non-leveraged ESOP, the company contributes stock directly to the trust or contributes cash, which is then used to buy shares. The leveraged structure is useful because it lets the ESOP buy a significant stake, up to 100% of the company at one time. The ESOP also helps shareholders access liquidity, improves company cash flow, and sets the stage for future employee benefits. Let's look at an example. Let's say we have a company worth $50 million. The owners want to sell 30% or $15 million worth to a newly formed ESOP. But here's the challenge. The ESOP doesn't have $15 million in cash, so the company will borrow that $15 million from a bank. This is referred to as the bank loan or the external loan. The company then loans the $15 million to the ESOP, creating the internal loan or the ESOP loan. The ESOP uses that cash to buy shares from the selling shareholders. So if we follow the cash, the bank lends it to the company lends it to the ESOP, and the ESOP uses the cash to purchase stock from the shareholders. Let's dig deeper on the two loans. The bank loan is between the company and a lender. It's typically secured by company assets and cash flow with standard commercial banking terms such as a 5-year term to maturity. The internal loan is between the company and the ESOP. It usually has a much longer term. For our example, we'll say 20 years. And it pays interest based on the IRS's applicable federal rate. Now, after the transaction is completed, the ESOP needs cash to repay the internal loan. That cash can come from two places: company contributions to the ESOP and dividends or distributions on the shares the ESOP owns. At the start, all ESOP shares are held in a suspense account. As the internal loan gets repaid, shares are released and allocated to employees' accounts. Let's follow the annual transactions step by step. First, the company contributes cash to the ESOP. The ESOP uses that cash to pay down the internal loan. The company can use the cash for any business purpose. Often it's used to service the bank loan. As that internal loan is paid off, shares are released from suspense to participant accounts. ESOP contributions are tax deductible up to 25% of covered payroll. Given the cash flow and tax advantages, companies may decide to maximize the ESOP contribution and prepay the internal loan. However, you'll want to exercise some caution with this strategy, as paying down the internal loan too quickly will cause shares to be released from suspense sooner, increasing employee benefits and accelerating the company's future repurchase obligation. On top of the contributions, the ESOP also receives dividends or distributions on a pro rata basis. For C Corps, dividends are often tax deductible to the company. For S Corps, the distributions aren't deductible, but either way, the ESOP doesn't pay tax on what it receives. The cash from dividends and distributions can be used to pay down the internal loan, boosting company cash flow. At first, leveraged ESOPs may sound complicated, but the key is following the flow of cash and shares between the company, the ESOP, and employees. Leveraged ESOPs provide employees with meaningful ownership while giving shareholders a path to liquidity. And when companies understand how a leveraged ESOP works, they're better equipped to manage cash flow, capture tax benefits, and build long-term employee ownership. Thanks for watching. Be sure to subscribe for more insights on how ESOPs create lasting value for companies and employees alike.